that gets basically distributed to the investors. And then the second part of that is, what about taxes, insurance, maintenance? So NIA participates in all of those as well. So if the homeowner owns 20%, they pay 20% insurance, they pay 20% taxes, they pay 20% major repairs like HVAC, roof repairs, whatever. And NIA, with its investors, pays for 80% taxes, 80% insurance, 80% of major repairs. And so what you get is a partnership. It's like you and I decided to buy a house together, and one of us is renting the home. And then what happens is that the homeowner can buy additional equity in the home at whatever the market value is. So let's say it goes to $100,000. Let's say it's at $100,000, and then it goes to $102,000, the house value. So they can buy some portion of the home at $102,000, for example. And they can slowly start to build up their equity to eventually own the whole home fully. So you can see kind of in this example that let's say the homeowner decided to sell the home, and now it's from 100K, it went down to 80K. Well, NIA will take whatever portion that it owns, it will take that up 80K. So there's no loan here, there's no lien on the property. It's NIA and this homeowner owning the property together. It's a partnership, it's a fundamental partnership, right? And that really brings a genuine, authentic relationship where we participate in all of the gain, but also all of the potential losses. So relatively to other options, we're sharing in profit and loss, we're sharing in property taxes, insurance. There's no selling to Freddie Mae, Fannie Mac, because the money that's sourced to help buy these homes is from the community, and there's also no foreclosures, and we can talk about that a little bit further later. Now I'm going to get to your question of like, okay, how is this possible? Like, what is the investors getting out of it? I promise I will get to that question. But briefly, just about kind of us and what stages that we've taken to get here. So Sheikh Khan, he's our Sharia advisor. He serves on the Fifth Council of North America. And then just broadly touching upon the timeline of where we've gotten to so far from the community's help, alhamdulillah, is in 2022 we started to explore like the compliance of this, what does it look like. There are a couple of other models actually like this. One is called Amin Housing, it's based in California. It's more of a co-op, but they only service California and started to in Texas as well. And then there's also Ansar Co-op in Toronto, Canada, but no one has taken it kind of nationally. And alhamdulillah, that's what we've been able to achieve. We're in about 16 different states today. So in kind of mid-2023, that's when we bought our first home in Dallas. By 2024, we had purchased about 11 homes, and at the end of 2025, we had about 40 homes in 15 states. Today, we're at about 48 homes across 16 different states, and our goal, inshallah, is to get to about 100 homes by the end of the year and be in about 25 states, inshallah. So this is a little bit kind of the footprint of where we have properties. You can see that we're pretty spread across the country, and it's by design actually. And I'll kind of explain from an investment perspective why this is beneficial for the purposes of helping understand of like if we create this circular economy, this model, that it should benefit all parties involved. This shouldn't be charity from getting from investors. It actually can benefit investors, and it's actually the best way to do so. Now, I'll explain that in a minute. This is like a testimonial from one of our homeowners who was relieved about truly finding a Sharia-compliant home financing option. There is a downside of this approach. We're not selling Freddie Mae, Fannie Mac. I think this is outdated. We have close to 2,500 people, maybe actually even closer to 3,000 people on our wait list who are waiting to buy a house with NIA across the country. I think in probably 47 different states. So the downside of us not being able to sell to like an institution like Freddie Mae or Fannie Mac is that we have to ramp up of community capital to be able to provide and support these homeowners. So the way that we do that is that we prioritize people who need less than $300,000 from our side to be able to purchase a home. they should be in like in a key expansion market. Actually, Michigan is an expansion market for us. It has been performing very well in terms of rental income and in terms of appreciation. And if that they're an investor in our fund. So that's kind of how we prioritize our wait list. We typically are batching people about like 10 to 15 per quarter and then giving them the green light to go and look for a home. And it's a cash offer that we're doing with the homes that we're purchasing. So I kind of talked about this, but key markets right now is Michigan, Chicago, and New Jersey, New York. And the reason why is if you look at the housing market in general, it's actually moving. Before, it kind of moved in sync with each other, with everywhere across the country based off of interest rates. And now it's starting, since COVID, it's started to lessen to do so. And the primary reason of that is because of inventory levels. So inventory levels in the Northeast and Michigan, relatively to the rest of the states, are very low compared to the demand there is. So it's pure demand and supply. And so that's why we look at this data almost on a weekly basis, and that's what kind of informs our decision to prioritize certain areas or not. So like when someone invests in NIA, they have a piece of basically all of these homes, if you will. Now this is my favorite part to talk about, which is like people ask like why would like an investor do this? Like if they can just park their money and get like a fixed return, why would they want to bear the risk of participating in expenses and where the prices go? So I've actually been to Michigan several times. I started buying property individually in Michigan in 2016 in Warren and Roseville. My aunt lives in Sterling Heights. And so we actually had, before NIA, we had 4 rental income funds, and we had about 100 properties across Michigan. So we did that from 2016 to 2022. And it was good, we met our returns, but it was the most harrowing experience for me because having to deal with 100 properties despite having 2 property managers was extremely painful, especially during a climate like COVID. The reality is that a landlord and a tenant, they sit on opposite ends of the table. It's an adversarial relationship fundamentally. The tenant has no skin in the game in the house, and the landlord has 100% skin in the game in the house, right? So it creates a model that is fundamentally like adversarial. And it took me about 14 months to even sell all of those 100 properties. The life cycle of the fund had ended. So I'm very familiar with the Michigan market and the battle scars to tell you that the traditional rental investing market is very, very difficult. But with the NIA model, it's actually very different because the person, the individual that we're partnering with, they're putting 20% down in the house. They have skin in the game. They are a owner of the house. And we are also an owner of the house. And in reality, they are the dream tenant that any landlord could ask for. Because you know what? They own part of the house. They take care of it completely differently than a normal tenant would. They take care of like the minor expenses. They're kind of like the pseudo property manager of the property. And they're actually participating, whatever share that they own, in taxes, insurance, major expenses. And we virtually have no tenant turnover versus in the traditional model, every 15, 16 months, someone moves out, change the carpet, paint, get a new tenant. The whole process takes like 3-4 months and ends up losing so much money. So my favorite part about this is like the Halal model is actually a better model, not only for the homeowners, but also for the investors. And that's like the core principle that I was trying to get across with this concept of when we look at things in a non-GRIVA aspect, what we're doing is creating the circulation of money that benefits all people. And when we do that, that's when we can create really a system that works for all people, not just one type of people, right? So we don't have to necessarily rely on charity and zakat, which are all good things, but we're encouraged to actually invest our money, and we can do so kind of in a proper way in this model that kind of benefits all. And it's just a testament that when you try to do things in a halal way, that it is the better model. It just sometimes it's hard for us to kind of see it because we're so accustomed to debt and riba and just seeing it in every aspect kind of our lives in this country. I don't want to talk too much about the investment side. If you're interested, you can come talk to me after. But one thing I want to highlight is that most of our community is pretty overexposed to the stock market. And I guess you could say in the last couple of weeks, for those in the stock market, you might have felt it a little bit more. But most of our community has most of their assets in the stock market, and it becomes a really big issue as you get older. If you look at like a traditional investment portfolio, and I have kind of like a personal finance guide on the website called Muslim.finance. You can check it out after. But if you look at a traditional investment portfolio, as you start to get older, as you start to get like go to from your 40s to your 50s to your 60s, the stocks component goes from like 90% to like more like 60 or 50%, and they call it fixed income, which is basically like bonds, goes from like 10% to 40%. But we don't have that option as Muslims. So what ends up happening is that most people just keep most of their money in the market. But then you get weeks like what happened in the last few weeks where there's so much volatility and everybody gets panicked and scared and doesn't know what to do. And especially if you're older, you might not have the time horizon to recover that volatility basically, right? So we as a community, we kind of have to, irrespective of whether it's in real estate or not, start to kind of reduce our exposure to stocks, especially those that are older and kind of getting towards retirement. And the only kind of model that I know that can provide not fixed income, but kind of the closest to it. There's some people like to talk about sukuk, but personally for me, I think real estate is a really good option of that, of kind of getting a stable income for your portfolio. So to date, we've raised about $14 million. We have about 48 homes. We have about over 100 investors with us who are getting consistent dividends on a quarterly basis. So that's kind of the foundation that allows us to go and help this 3,000 people wait list who are waiting to kind of buy a home with us. And just to talk a little bit about our goals for 2026. We're looking to raise another $15 million, inshallah, to reach about 25 million. And we want to get to about 100 homes this year, inshallah. Last year we grew about 300%. So this year we want to continue that momentum and at least double our portfolio, inshallah. And we want to be able to reach about 20 different states. So with that, I'll open it up to Q&A if you have questions. Yeah. So the question was, is this similar to a lease-to-own model? And the second question is, who actually owns the house? So one of the unique things that we've done is that when a resident comes in with 20%, they're not actually forced to buy additional equity in the home. Like if you're older, you might not care, for example, of owning more equity. So it's not a traditional lease to own, because a traditional lease to own is like you're kind of on like a fixed schedule to buy a certain amount of equity a year. You can buy additional equity in the home, 10% every year in the NEO model, but it's not required. So we have a dual relationship with the homeowner and the tenant. One is they're a co-owner of the property, and the second is that they're a tenant for whatever portion that they don't own from us. So it's similar to lease to own, but not exactly. The second question is, who actually owns the property? Both parties do. So the homeowner and NIA. So on the deed, it'll literally say homeowner and NIA Fund 1 LLC. So there's no lien, there's no loan on the property. It's direct ownership, and that's why there's something called depreciation in real estate investing, which is it's kind of like a paper expense, and you're still eligible for that with NIA because you as an investor have direct ownership basically in all these properties. So the question is, if there's any loss in the market, will NIA participate in that? The answer is yes. Now the question is, how do we mitigate that loss for our investors? There's a couple of components in there. Number one is, like I mentioned, that housing markets are kind of moving independently from each other now, right? So the Northeast is moving very fast up versus Dallas, Denver, for example. They're kind of flatlining. They haven't gone down a lot, but they're kind of flatlining in terms of growth. So one is, if we're diversified across so many states and so many housing markets, some are going up, but some are going down. So there's the diversity kind of helps us there. Number two is we're also diversified in terms of the number of homes that we have. So we have 48 homes. So for example, let's say there's a roof repair of $10,000 for a property, and we participate in that. Relatively speaking, we have 47 other homes that are bringing us rental income, so it's going to impact the property, the value, the returns of the fund basically much less, versus if I just had one house, it's going to wipe away like 2 or 3 months of income, right? The third way is that we, on an annual basis, we adjust both the rent and the property value. And so the rent can go up, it can also go down. Now, to make it affordable for the homeowner, one thing that we've done is that we've added a cap on the upside, on both the rent and the value of the home. So if the rent is $1,000, it cannot go up by more than 5% a year, because we don't want to make it like the value went up so high, like in certain markets, like even Canton has gone up significantly, and then the homeowner cannot buy additional equity in the home. We want them to buy additional equity. So there's a 5% cap, but then there's no cap on the downside. You cannot have a cap from a Sharia perspective. The last point here is that we cap how much equity that they can buy. So they cannot buy more than 10%. So for example, in a year. So for example, let's say we had a home for 100K, and let's say the value went down to 95K, okay? And let's say they bought 10% of equity. So they'll be buying $10,000 of equity for $9,500. So we're taking a $500 loss there, but the risk is kind of reduced and mitigated because we're only allowing them to buy 10% over a year. So there might be dips in the market that we can handle, but over the long run, we see the property values appreciating, and we have to monitor that, and that's how we're kind of mitigating the risk in that aspect.
So there is a prepay penalty, right? If you pay early, like more, like you say, there's a limit to how much you can pay.
So yeah, the question is, there's a prepayment penalty. So not really, because the price is not determined up front. Like when you get a typical mortgage, they're giving you a $100,000 mortgage for $200,000 divided by 30 years. Okay, it's the price of the equity is set at whenever you're buying it. Basically, it's done on an annual basis of the home. We use there's something called, the government publishes actually some data called the housing pricing index. That's what we use to determine that. So if it went up, if it went down, at whatever year it is, basically we assess annually at the purchase date. That's what the price will be. So it's not like there's no necessarily a penalty for paying. There's no fixed price basically up front.
You said like the tenant has like a share of the property, right? 120%. So like what happens if the tenant doesn't want the property? Is like the people have to buy them out?
Yeah. So the question was the tenant has to have 20%. What happens if they don't want to live it anymore? So in our model, our risk is significantly reduced compared to traditional rental investing that I talked about, because the tenant lives in the home, right? They're kind of like the property manager, the way that they take care of this completely different. So we do require them to sell the home if they don't want to live in it anymore, right? Now, another question that gets often asked is like, what happens if they can't pay the rent anymore? So I kind of mentioned it earlier, but we also don't have a foreclosure model. So the definition of foreclosure is basically you lose all of your equity if you cannot pay anymore, right? So with our model, what we do is, let's say someone owned 20% of a house, $100,000 house, and they cannot pay rent. We deduct that from their equity for up to 3 months. So because they have equity in the house, we we deduct it from their equity, and if they still can't pay it, then we will force them to basically sell the house. And then whatever their 20% is, minus the 3 months of rent, that's what they get back. In a traditional model, if you can't pay anymore, even if you own like 80% of the house, all of your equity gets wiped out. So that model, this model kind of prevents that and preserves someone's equity, even if they can't pay for a period of time.
They sell the house, they get a percentage.
Yeah, so the question is, if they sell the house, do they get a percentage? Yeah, so let's say they own 40% of the house of equity, and the price when we bought it was 100,000 and now went up to 200,000. They're getting 40% back of $200,000, right? So it's like you and I basically bought a home together. And let's say we were 50-50, whatever the price goes up, down, whatever it is, we're gonna share in that percentage, whatever it is.
How does it work for the investors? Are you selling shares or something?
Yeah, so the question is, how does it work for the investors? So we are creating shares, and the investment is across the entire portfolio of homes. So it's not for a specific house, it's for, we have whatever, 48 homes today, and if we get to our goal of about 100 by the end of the year, it will be across all of those homes, right? So it's diversified across number of homes and geography, which is very important in order to get to do the risk mitigation that we were kind of talking about earlier.
How do they sell that? Say if they want to.
So the question is, how can they sell? So we just ask for a 3-month notice, and they can withdraw. We do that because we are constantly raising capital. We raise about $3 million a quarter, and we have some anchor investors to kind of help us.
What's the minimum amount in order for people to get into the investment portion of
For the investment portion, it's about 50K is what we ask for the minimum amount. Yeah,
that's the minimum?
the minimum amount. Yeah.
I have other questions, if at all possible.
Yeah.
How could a person get into this model? You know, like, do you guys have a base amount of money that a person needs to come up? Just like a down payment, sort of. What's that amount?
Yeah. So the question is, how can someone get into this model? So the answer is about 20%. We require 20%.
The value of the
Whatever house that you're trying to buy, it's 20%. We also do refinances, by the way. So we did a bunch of refinances as well, like if you have an existing loan.
second question. What qualifies a home to be shared, you know, with me? In other words, to give you an example, could people purchase, let's say, a farmhouse versus, you know, a house?
Yeah. So the question is, what qualifies a home in NIA? So we only do like single family. We only do residential properties, so single family homes, townhouses, condos, and again, the person has to live in it. And then we pre-qualify, even before a particular house, we pre-qualify on the area and the state. So only states that we want to participate in, we prioritizing those and helping people buy homes in those properties. And then on the individual house, there's some, depending on the area, we'll maybe be subjective to it. So we might try to avoid like vinyl homes, for example. People don't like that in Michigan. And then also, we do an inspection on the property as well. So it has to comply with, we have to look at it and see if it's a good investment because it's an equity ownership for us.
Third question. On the investment side of things, you said that this mainly is stocks. So who does keep an eye on Sharia aspect and the Halal aspect of the, stocks that are being sold?
So we don't invest in any stocks for NIA. It's just in homes. Yeah, I was just giving an example that most people, in terms of personal investing, they have all the money in stocks. Yeah.
Misunderstood. I thought that was part of your
No.
portfolio.
Yeah. If you want a tool to be able to look whether a stock is compliant or not, our same Sharia advisor, Sheikh Khan, he's also an advisor for a company called Zoya, Z-O-Y-A. You can also look at any stock and see whether the stock is compliant or not. So him and Sheikh Joe Bradford are the advisors for Zoya.
Do you pay the tax for the house?
The question is, do you pay the tax tax for the house with the tenant. Yes, we pay the property taxes with the tenant. Yeah, whatever portion that we own.
You split it.
We split it for whatever portion that we own. Yeah. No.
So you answered one of my questions. So you also buy multi-tenant apartments and buildings like that?
We do not buy multi-tenant.
Oh,
We only buy single-family condos, townhouses.
Okay.
So our risk model is like the person has to live in the house, right? So that reduces the traditional residential investing.
So just a couple other questions. Can you, as an investor, can you participate in just the Michigan market or Dallas market?
Yeah, the question is, as an investor, can you participate in only the Michigan or the Dallas? No, it's diversified across all markets. Yeah.
That's the only way they mitigate.
Yeah.
If I decided to invest, let's say I put a 50K investment with you guys, and after 1 year I needed the cash, I needed my money back. What happens?
Yeah, so the question is, what happens if I need my investment back? We just ask for a 3-month notice. So you let us know, and within 3 months we can return to you back your capital, basically.
Could you repeat the question?
The question is, how about if you need your investment back, and we just ask for a 3-month notice?
Oh,
Yeah.
And the profit?
We distribute on a quarterly basis the dividends. Yeah.
For the maintenance component, do you validate that maintenance is really required? Because if I'm only paying 20% of changing my AC, it's a big incentive, right?
Yeah. So the question was about maintenance, like how do you validate that? So we have a list of pretty much like what is considered major repairs and minor repairs. So like a toilet leak, we will not participate in, but like major stuff like AC, think of just like a few $1,000s, AC, roof, whatever, we will participate in. We also do not participate in cosmetic upgrades, but we will credit the value of that if the house is sold within 5 years. If it's like considered for like a selling upgrade, basically.
So you trust the tenant basically if he says my roof needs changing and he just wants to change it for looks. You just trust it.
No, it would have to be, any major expense would have to be because out of need, not because of cosmetic reasons,
How
basically.
do you validate that?
Because we review, like, they have to ask us if they want to spend anything, and we have to approve the invoice, basically, and it has to be like a contractor that is licensed or whatever, stuff like that. So it's as if we're owners. There's a sister's question, so I'll
Yeah.
answer.
Can an investor roll over their IRA into your program? Like,
Yeah. So the question is, can an investor roll over their IRA into the program? Yes. You have to use something called an alternative IRA custodian. So one that most of our investors use is called IRAresources.com. You can send me an email after at Safeer, SAFEER @nia.com, and I can happy to answer more questions about it.
The name of the alternative IRA?
IRAresources.com.
You mentioned earlier, Amin Housing, which is called out of California. They've been around for a very long time.
Yeah.
But they haven't really scaled to base still in Michigan. You mentioned that they're more recently in Texas. How are you guys different? Because some of the things I've been hearing is really similar to
Yeah.
Amin Housing is different.
Yeah, so the question is, how are we different than Amin Housing? So the model is very similar, 90% different. The 90%, sorry, 90% same. Sorry. It is, the main difference is that Amin Housing is structured as a co-op, so it's like a non-profit like a masjid. So that kind of gives, they've gone through some leadership changes, so it kind of gives like instability to the organization. We are not structured as that, we're structured as a for-profit. So it gives comfort both to like our homeowner side and our resident side. The other difference is that Amin Housing doesn't share equally in insurance and taxes. They give a 7% discount on the rent, but they instead of sharing like whatever portion that they own. So that's the core differences. But they have scale. They have about $140 million of assets. They started in 1980, but they pretty much only service to California, and many people have been begging to come to other states, which they haven't done so.
And to follow on that, one of the biggest challenges is that your customers, people who want to live in houses, are maybe expecting the American way of
Yeah.
buying a home, which is I want to close in 30 days. Can you guys do something like that? Are you
Yeah, so the question is, they're expecting to close quickly, so we are a cash closing. So we have some amount of reserves in the bank that we kind of anticipate and schedule people on a quarterly basis. So when your turn comes up, we're telling you 6 months in advance, this is your window, January to March to go buy a house, and we'll tell you to start making offers even like mid-December basically. So
You're saying you coordinate.
yeah, we can close quickly.
How liquid is your investment and what's the projected rate of return?
Yeah, so the question is how liquid is that investment and what's the rate of return? We have 5 minutes, right? Okay. So most of the assets are basically in the homes. This temporary component of as people are buying homes, as they're scheduled to buy in the quarter, we have some cash basically in the bank account for that portion. Because we need to have that in portion while we're kind of making offers. So it's relatively small amount, like we have, whatever, $14 million of assets. We probably have like maybe shy of $1 million in the bank account, but we have pre-scheduled residents who are looking to buy a home with that. The rate of return is about 5% in terms of rental income and 2 to 3% in terms of appreciation. So that's total is 7 to 8%.
So obligations can be fulfilled for liquidity?
Yeah. So the question is, obligations to be fulfilled for liquidity? Yes, in 2 parts. One is we are constantly raising every quarter. And number 2 is we have some anchor investors who are there for an extended period of time and can add additional capital basically if it's needed, if someone needs to withdraw.
Is all that information on your website?
If you go to the website, there's like an invest button, and then it'll send you an email with more information about it. Or you can contact me at safir@neo.com.
I don't know if you mentioned this already, but the wait list, is it state by state or everyone together?
The wait list is, we prioritize people off of how much that they need, number 1, less than 300,000, or now it's 400,000. The second is states that we want to prioritize based off of the data that we observe on markets. So Michigan is a priority market for us right now because the house prices have been consistently going up and the rental yield is up. Generally, the Northeast right now is a priority market for us.
But am I competing with the other states in the Northeast as on the wait list?
Yes, but if you are an investor, so we have a program called Home Ready, you can invest as you're like looking to save up your down payment. You can you can have almost instant priority within like a 6 to 12 month window to buy a house by investing. I'll take 2 more questions and then I'll be around for more questions.
So how does if refinancing or something in the current market works, like if you want to take down, if I have 50% down equity, I want to take somehow, is it possible?
Yeah, the question is about refinancing or taking out equity. We don't support that at this time. We can do a refinance, but we can't do a cash out refinance at this time. I'll do 1 more question. Yeah. Yeah, so the question is, how do you calculate the rent and the house price? So the government publishes data called HPI, Housing Pricing Index, for each metropolitan area. That's what we use to adjust the house price. Whether it's once a year on the anniversary, same thing with the rent, the government publishes fair market rent for a particular zip code. And bedroom sizes, that's what we use. I'll be around after the show for more questions, inshallah. Jazakallah, assalamu alaikum.
Jazakumullah khairan. Thank you, Brother Safir. Allah reward you. We have refreshments outside, so if anybody is interested, assalamu alaikum.